Hi, it's John McNally from NFP's Merger and Acquisition Risk Solutions Group. I want to talk today about two products that aren't widely known in the market, but each of them, and they serve different purposes, can have an enormous impact on either helping a deal get done or allowing a fund to wind up and liquidate at its sort of the natural end of its life cycle without there being issues preventing that happening. So the first one is what we call litigation insurance, or sometimes contingent liability insurance. The idea is where the target company in particular in an acquisition has a piece of litigation. It could be securities litigation, shareholders securities suits. It could be something like TCPA, the Telephone Consumer Protection Act, which generally are class action settlements that need to get done. But it could be prior to a settlement being agreed. It could be a wage and hour or another employment issue. It could even be products liability and in some cases asbestos issues where it's very difficult to get arms around and box something up. And the idea is that where the uncertainty both for buyer and for the sellers and target business is this a defensible case and it's going to be $500,000 to defend it and we think we can win? Or is it going to be something that's material? Let's say a reasonable worst case outcome is a $20 million judgment. If you're looking at $100 or even a $250 million transaction, that 8 or 10 or 20% uncertainty on valuation that's caused by the potential outcome of this litigation makes it very difficult for buyer to inherit that without really knocking down the purchase price or demanding, a big amount of proceeds being put in escrow by seller. And if that litigation carries on for several years, that's a very difficult position for sellers to be in. The good news is there are a number of insurers. There aren't as many as we have in other markets, like for tax insurance or especially rep and warranty insurance, but there is a market. There are insurers that have appetite, they have capability, and there are a few brokers, including NFP, who have worked with these types of products and really help either save deals or make them better priced. If you can get for some cents on the dollar, if you can make material litigation go away into an insurance policy, that's a great result. The second product we want to talk about, which is even less well known, is what we call fund liquidation or fund wind-up insurance. The idea here is at the end of your fund's natural life cycle, you've just sold the last portfolio company or you're about to do so. And the concern is that you want to be able to wind up and liquidate the fund and return the final proceeds to your LPs and to your investors. But certainly your auditors are going to take issue if you have outstanding, and your lawyers as well if you have outstanding issues with respect to indemnities, specific indemnities that were given that may still have some period of the survival term left at the time you are selling or have just sold your final couple of portfolio companies. You may have even fundamental representations that go to the title and capacity and ownership of the shares that, in some cases, when the deal was negotiated, they may have an indefinite survival period. So even if you had insurance in place, rep and warranty insurance in place, it's not going to pick up, beyond 6 years. And so you may have some very attenuated but still existing risk. And so, again, I think the good news is there is a limited market. There are some insurers, not a large number, but those with capability and, again, appetite to put in place, and in most cases it's a zero deductible policy so that you really can effectively distribute out remaining proceeds to your investors, a policy that covers all of the outstanding risk that's left, whether it's specific indemnities, tax indemnities, fundamental reps that have indefinite survival, and obviously we could have this policy extend out for another 5 or 6 years. And the idea is now you can get your auditors comfortable that you've boxed up this remaining risk on a zero deductible policy or a very low deductible policy so that you're able to distribute out ideally all of remaining proceeds to investors and lock in your IRR and have much happier LPs.